Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Tax cut tantrum, stocks and bonds sell off as markets take fright at the ballooning US deficit. Lawmakers work into the night on the detail of Trump's tax cuts. Oval Office showdown. President Trump ambushes Cyril Ramaphosa with a video claiming genocide against white farmers. The South African president says closed-door meetings and talks were constructive. Plus, ChatGPT, build me some hardware. OpenAI snaps up a device startup founded by Apple designer Jony Ive, the company's biggest ever acquisition. Happy Thursday. European futures pointing lower then after softness across the Asian session and significant drops in terms of the US market action yesterday, with the Nasdaq closing lower by about 1.4%, the S&P 500 dropping about 1.6%. Significant selling then on concerns about what is transpiring around the tax cuts and spending bill that is now working its way potentially through Congress. We watch the machinations, of course, as lawmakers wrestle with the wording and the detail, and some news could cross on that in the next hour or so. FTSE 100 futures currently lower by 0.6%, so a session in the UK that's set for weakness as well. S&P futures, after the losses yesterday that I flagged for you, currently stabilising, edging into the green. We'll see if that can hold, of course, on the details of the politics and the tax bill that's working its way through the US. Nasdaq 100 futures also currently stabilising after dropping 1.4% by the end of the close yesterday. Let's flip the board and have a look cross-asset. The focus really is on what's happening in the Treasury market, because you saw yields up across the curve yesterday as markets reassessed just their level of concern about the build-up of debt in the US. A soft auction in terms of 20-year notes as well. 458 right now on the benchmark 10-year. The question from our MLive team today to our audience is, when do we get to 5% on the 10-year, which we know is in focus for the US Treasury Secretary Scott Bessent in terms of that part of the yield curve and his attention. Euro dollar at 113. Softer dollar again in the session today. 4 straight days now in terms of weaker US dollar, and you're seeing the gains in Asian currencies on the back of that. Gold currently gaining as well in this risk-off sentiment, up 0.7% on the yellow metal, and Bitcoin above 110,000 per coin for the first time ever, gaining 3%, and part of that is down to regulatory changes, again working their way through the political mechanisms of the US. Let's flip the board and have a look at the Asian session then. The focus, again, on the currency space. We've been having meetings once again with US officials and some of their Asian counterparts. The yen is stronger in the session, 143, up 0.3%. That is one of the factors that's pushing the Nikkei down about 1% so far in the session. Japanese stocks under pressure again. The broad index across the region down 0.6%. Over in Hong Kong, the HSI also softer by 206 points, down 0.9%. Let's get to the US then and what is happening right now, because Republican leaders in the United States House are pushing a new version of President Trump's massive tax and spending bill to try and win support from warring GOP factions. The House could vote on it as soon as today, potentially in the next few hours. Bloomberg's Jill Desus joins me now with the latest. What is in the new bill, Jill?
Well, Tom, there's a lot that's still kind of in the works here. First of all, we have the elimination of some Biden-era clean energy tax deductions. We've also got, some additional sort of speeding up to some Medicaid cuts that some hardliners are really looking at. But it's really that state and local tax cap, that deduction cap being raised to $40,000. That's the central piece of this here. We had several Republican holdouts, mainly from high-tax states such as New Jersey, New York, California, that were really pushing for an increase to this limit. Previously, when Donald Trump was first in office in 2017, that first version of the tax bill came into effect here. We saw that limit set at $10,000, or previously was no limit before. That's really something that they had been pushing for pretty heavily with this version of the bill, and a big concern for House Speaker Mike Johnson in terms of actually getting this passed through the House. So that's now been raised to $40,000. So again, that's sort of the big central piece of this. Now, again, they still need to actually put this thing to a vote. Still some additional concerns from more of those, again, hardliner Republicans when it comes to, sort of what impact this has on the fiscal deficit, some additional, changes they'd like to see there. But that's really, I think they've cleared a pretty high bar there, just being able to sort of reach some kind of a negotiation and agreement on SALT.
Yeah, SALT, which is kind of an acronym or a word spaghetti, or it's a letter spaghetti that we're trying to get used to outside of the US, because it's quite granular to some of the tax policy and details, kind of state by state, isn't it? Explain why it's so, Jill, why is it so contentious, this bill, and where does it leave those discussions on the US's ballooning deficit that it seems the bond vigilantes are now waking up to?
Yeah, well, I mean, look, Tom, what you're ultimately looking at here is Trump trying to get some kind of an extended version of his pretty landmark 2017 tax cut bill. Obviously Democrats are left out of the conversation this time around. The Republicans have a majority in the House, but you still see a lot of those differences when it comes to those Republicans. I mean, again, that state and local, tax deduction was a pretty central part of this, because you have a lot of Republicans that are still representing fairly high tax states that are trying to get their piece of this. On the other side of the equation, you did have a lot of hardliner, conservatives that were trying to come down on how were they going to, try to get in, Medicaid reductions in some cuts there. And that was a big central focus for them. Of course, any moderate Republicans in places where they might have constituents that actually depend on various Medicaid programs are going to be pretty against eliminating those kinds of things. So you see a lot of that entering the conversation here. And then obviously, yes, I think as you're seeing the bond market react to this, the ultimate concern is that if you kind of concede to everyone here, then what does that do to the size of the fiscal deficit? Donald Trump actually floated the idea of taking Fannie and Freddie Public, they brought under the constituency of the U.S. government back during the 2008 global financial crisis. This idea of the return to profitability now, maybe that's something that you could do to sort of free up some revenue. So lots of ideas floating around there. But yeah, I mean, when it comes down to it, if you've got this tax cut bill in the works, you're trying to appease all sides here, then yes, that does obviously lead to a lot of concerns about, for some of these fiscal hawks.
OK, and we'll watch, of course, to see how much progress is made in terms of voting on that bill in the next few hours, potentially. Jill Dees breaking it down for us. Thank you very much indeed. So concerns about the tax cut bill and the ballooning deficit triggered a Treasury sell-off. We talked about the bond vigilantes. They seem to be off the sidelines right now. Let's bring in Bloomberg's Valerie Teitel for the detail. What warnings, then, are investors in the bond market sending around these tax plans? Yeah,
some pretty decent warnings from the Treasury market, Tom. The 30-year yields for the first time this year closed above 5% in yields, and they did it in style. They breached 5.10 in the Asia session on the Asia Open. We're now trading 12 basis points higher just in the last two sessions, hovering near these weekly highs. Very interesting to see that this move wasn't snapped back in the Asia session. We're still hovering at these levels. And take a look at the price action yesterday around this week 20-year auction, Tom, that came around 6 p.m. London time. We saw Treasury prices decline across the curve after that week auction. And then you saw the equity market, that's this line here in white, completely slammed. I mean, it fell near 2% after this week auction. Just really goes to show now that the equity market is really worried about this rise in the long end yields.
And put that rise, particularly in terms of the 30-year, now, as you say, back above that 5% level, and not insignificantly, with the comfortable kind of 8 basis point move above that. Put that into context for us, Val, and what it tells us about the lack of appetite right now for U.S. Treasuries.
Yeah, Tom, I mean, those 30-year yields, we're getting very close to breaching cycle highs, just less than 10 basis points away from cycle highs in October 2023. And if we breach that, Tom, we have to go all the way back 18 years back to where we saw 5-year yields trade or 10-year yields trade above 5.20. And this is continuing to be very unusual because the U.S. economy is slowing down. We normally see long end yields rally when growth is starting to slow, which is really showing that it's these deficit concerns, it's supply and demand factors, which are front and center for the Treasury market. And this is something that's really never happened in terms of price action for Treasuries, that supply and demand concerns almost dwarf growth and inflation factors. So this is another warning sign, maybe to Congress and to President Donald Trump, warning on this spending and this debt load. Another thing that is a bit unusual about this price action, Tom, is normally when we see yields rise, we get the dollar dollar rising with it. That has really not happened again this week. We've seen the Bloomberg Dollar Spot Index fall to a one-month low. And that is another sign that this is a sell America theme coming back. This is that EM dynamic where you see yields rise, the currency weaken, and the equity market weaken, which is a sign almost of capital flight leaving the U.S.
OK, the sell America theme back in focus for investors. And again, a shot across the bow for lawmakers in Washington, D.C. and the president as well. Bloomberg's Valerie Teitel, thank you for walking us through the market action. President Trump has had another tense exchange, meanwhile, with a world leader at the White House. Quite remarkable scenes. His meeting with South Africa's Cyril Ramaphosa was seen as a chance to mend relations, strained by the U.S. president's repeated allegations of a genocide against white farmers, claims that Ramaphosa denies.
It will take President Trump listening to the voices of South Africans, some of whom are his good friends, like those who are here. When we have talks between us on around a quiet table, it will take President Trump to listen to them.
OK, let's get more with Bloomberg's chief Africa correspondent, Jen Dabasaja. Jen, this has been described by some observers as another ambush by the US president, following, of course, the scenes in the White House with the Ukrainian leader a few months ago. It seems to confirm the fears then, the worst fears of some of Ramaphosa's advisers. Did he walk into a trap, essentially?
Well, Tom, if you take a look at what President Ramaphosa's own top chief spokesperson said, he called it himself an ambush, and that is really the term that we're seeing circulating around a lot of media headlines. The fact is this: President Ramaphosa walked in here with a number of priorities. He did want to dispel a lot of these claims that President Trump and others have made about the situation that is happening on the ground in South Africa. But from what we are told, the format of the meeting changed. Clearly, as you can see, there were props involved. There was a presentation involved that clearly caught off guard the South African president. You could see, though, that he did his best to keep his cool and tried to at least bring it back to the issues that he walked in wanting to address, which is trade and investment and strengthening and potentially even resetting ties between these two countries. But it seemed, at least from the comments that President Trump was making, that he had made his mind up about some of these claims. What was interesting, though, was that President Ramaphosa brought alongside the leader of the opposition party, his name is John Steenhuisen. He's also the Minister of Agriculture, who prepared his own speech and talked about the situation there on the ground. President Trump's own friends, as he calls it, South African golfers, were in the room. Johan Rupert, who is a billionaire from South Africa, also talking about the issues that do exist on the ground in the country, but trying to at least clear the air about some of these unsubstantiated claims that Trump continued to talk about. Now, the question is, where does this go from here, and what does this really mean for this bilateral relationship and also for the G20 later this year?
Well, what on that front will you be watching for in terms of informing us about where that relationship goes and how it develops?
Well, what we heard from President Ramaphosa afterwards is that, yes, we did see this scene in the Oval Office, but afterwards they were able to get back to the priorities that he walked in wanting to address: trade and investment, talking about AGOA, which is this preferential trade agreement that a number of African countries have shared with the U.S. that is expiring later this year. He said that they were able to get away from some of these claims about genocide and also land being taken from white farmers and get to the issues. And the question really is, what does this mean for President Trump? It's not only the G20 that is happening in South Africa later this year, but also President Ramaphosa during this meeting talked about how the U.S. is integral to the G20. And next year he is planning to hand off the presidency to the U.S. It's meant to be hosted in the U.S. next year. And so having the U.S. president present at this leaders meeting later this year is going to be integral to what happens moving forward for these countries. This is also, when you take a look at the bilateral relationship between just South Africa and the U.S., the U.S. is South Africa's single biggest trading partner. There's at least 600 American firms that operate in the country. So this is a very important part of even the growth story for the country. And President Ramaphosa, as the presidency, or as the president, excuse me, of the G20 this year, is really seen as a leader and a spokesperson for the global South, and potentially the only person from the African continent who can speak to and meet President Trump where they are at. And so hopefully some of the theatrics that we did see in the Oval Office doesn't ultimately result in this breaking down. But the devil will be in the details when we hear more from these leaders and also a number of these representatives and officials that were in the meeting there, whether or not they were actually able to persuade President Trump that there is progress, there is definitely a willingness, and you know, they want to see the U.S. continue to cherish this relationship and invest into the economy.
OK, Bloomberg's Jen Zabasajja, thank you very much indeed on that meeting, of course, between the two leaders of South Africa and, of course, the US in the Oval Office yesterday. Coming up, gold holds on to gains on a rising US deficit concerns. We take a look at the Haven asset and other precious metals with Standard Chartered Suki Cooper. That is coming up next. How to position within the precious metals space. This is Bloomberg.
This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week right here on Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Gold holding on to gains as investors flock to the Haven asset amid rising geopolitical risks in the Middle East, of course, and as a weak US bond auction highlights fiscal concerns in the US. And we are now watching as lawmakers work through that tax and spending bill as well. Joining us now is Suki Cooper, precious metal analyst at Standard Chartered. Suki, great to have in the studio. Thank you so much for coming in. It's another big day for precious metals. We're seeing that bid again for gold. Just walk us through 12 months, up 40%. We've seen the year-to-date gains as well being pronounced. What are the current drivers for the moves into gold, and do you see that being sustained?
I think the number of factors that have led this gold rally, part of them were laid back in 2022 when we saw that central bank buying really pick up. And that's been a core driver that sustained this rally. That downside's been very well supported. But the big shift that we've seen over the past 3 months has been the inflow of ETFs. That was largely absent if you look at most of the 2024 rally, but that's really provided that additional catalyst coming into this year. But what's made the rally sustainable, it took 5 years to get above 2,000 on a sustained basis, but only a matter of weeks to stay above $3,000 on a sustained basis, is the fact that there are so many different drivers behind this rally. It's not that traditional correlation with real yields. It's been concerns around recession risks, concerns around tariffs and whether we see trade wars. It's been concerns around geopolitical tensions. So there's so many different drivers behind this rally that it's kept gold prices elevated.
And despite the run-up that we've seen in the last 12 months, 40%, this is not looking overcrowded at this point?
This is an interesting factor because when you look at a chart, it looks like it's quite toppy, and there's lots of concerns that price action has been quite frothy. But when we look at some of those measures that we can actually look at, they're not overcrowded. So tactical positioning, we're at lows that we saw back in February 2024. So the highs for the tactical positioning was back in 2019. So we're not overcrowded there. If we look at ETF flows, we're around about 400 tons off the peak that we saw back in 2020. So even now, when we look at inflows, yes, they've picked up across the US and Europe, but those new inflows are actually coming from China. And I think that's what's making this rally different, is that we've got additional demand here, and it's new demand as well.
OK, and you point to a number of catalysts. I just want to pick out one, which you point to starting back in 2022, which was central bank buying in significant quantities. What is your understanding of how much further that has to run? To what extent is that a structural change now in terms of the buying of central banks globally?
It has been because it's not just one central bank, it's not just one region. And we've seen multiple central banks coming into space, citing different reasons why they're adding to gold. Some may be looking for a target allocation, but others may be looking for diversification. It may be strategic. So the fact that we've continued to see this buying, yes, some of those volumes have been scaled back over the past quarter or so as prices have scaled record highs, but that buying is still there.
We're at 3,337 right now per troy ounce. What level are you targeting by year end for gold?
We think that there's a number of factors that could start to dampen gold's rally by the end of the year. Firstly, if we're looking at the correlation here, it's weakened with real yields, but it's strengthened with the dollar. So we're seeing that gold has been a huge beneficiary of safe haven demand amid a lot of the uncertainty. But as we're going into the end of the year, we think that if we see rate cuts, that could be a surprise that lifts gold up again. But if we start to see tax stimulus measures in the US and we start to see some of the uncertainty around geopolitical risks starting to unwind, we could actually see gold starting to stabilise at elevated levels. So remaining above 3,000, but perhaps potentially past its peak by the end of the year.
OK, what's the catch-up opportunity for silver before we let you go?
So the gold-silver ratio is one that's tracked very, very closely. And relatively, it looks like silver has underperformed, but silver prices are still doing very well, trading above $30 per ounce. The cost of production support is substantially low. It's below $20 per ounce. But we're seeing some of those concerns around recession risks weighing on silver price action. So there's still good growth when we look at industrial consumption, whether it's PV demand, electrification of vehicles. There's a lot of positive trends that are still in place for silver. But because the market is concerned about recession, that's weighing on silver's industrial component, and the investment demand hasn't offset that. And silver tends to fall during the past 7 recessions that we've seen in the US. Silver has fallen by like 15-16%. So it's weighing its dynamics between macro demand, but also that industrial weight on it.
OK, so that industrial demand potentially a bit of a cap on silver prices in a recessionary scenario. Suki, great to get your analysis. Thank you very much indeed for joining us bright and early this Thursday morning. Suki Cooper, of course, precious metals analyst at Standard Chartered. There's plenty more coming up. Stay with us. We're going to hear from Jamie Dimon, JP Morgan, and others, of course, as we continue to keep across the key themes of the day. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now some other stories making the news this Thursday. 2 Israeli embassy staff members have been killed in a shooting near the Jewish Museum in Washington, D.C. Police say a 30-year-old male suspect approached a group of 4 people as they were leaving an event. Officers detained the suspect at the scene. President Trump called the killings horrible and based, obviously, on anti-Semitism. We'll keep across that story for you. Bloomberg understands the European Union has shared a revised trade proposal with the US as it aims to inject momentum into talks with President Trump's administration. The new paper is said to include proposals that take into account US interests. It also looks to gradually reduce tariffs to 0 on both sides for industrial goods and what it calls non-sensitive agricultural products.
For the past few weeks, there's been discussion on the perimeter, but not on details of the tariffs. I think the period that we're living in is unprecedented due to the uncertainty in markets and the unpredictability of the Trump administration. I hope that things will stabilize and that the Americans will remain simple and loyal partners for the Europeans.
The US Defense Department has formally accepted a Boeing jet from Qatar as the new Air Force One for President Trump. The jet, one of the biggest foreign gifts ever given to the US government, has triggered concerns about conflicts of interest and national security. A Pentagon spokesman says the department will ensure the plane has the security measures and functions required for the president. Coming up, OpenAI is buying the AI device startup co-founded by Apple veteran Jony Ive, making a major push into hardware. This is a crucial story around AI and being embedded into hardware. We're going to get the details next. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. Happy Thursday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. Tax cut tantrum, stocks and bonds sell off as markets take fright at the ballooning US deficit. Lawmakers work into the night on the detail of Trump's tax cuts. Oval Office showdown. President Trump ambushes Cyril Ramaphosa with a video claiming genocide against white farmers. The South African president says closed-door talks were constructive. Plus, ChatGPT, build me some hardware. OpenAI snaps up a device startup founded by former Apple designer Jony Ive, the company's biggest ever acquisition. Let's get to these markets then. You saw the biggest drop in about a month for the S&P 500, dropping 1.6% by the end of the close. European stocks yesterday snapping a 4-day winning streak, ending up flat. European futures now pointing lower by 0.7%. All eyes, for now at least, focused on the tax cut and spending bill that may be working its way through the House in the next few hours. That seems to be the centrifugal force for these markets, at least at the moment. FTSE 100 futures pointing lower by 0.6%. Stateside S&P E-mini is actually turning around, pointing to gains of 0.1% after the losses of yesterday. Nasdaq 100 futures looking to add 39 points. Let's flip the board and have a look cross-asset. The focus then is on that Treasury curve, the yield curve, of course, after the sell-off yesterday, particularly pronounced at the long end, with the 30-year still above 5%, the 10-year at 4.58. How long before that ratchets up to 5%? That is a question from our MLive team today. The dollar is down again. Yields up, the dollar down. That relationship has broken down again. Euro dollar at 113. Gold getting a bid on this risk-off move that we're seeing broadly across the markets, up 0.7%. And Bitcoin above 110,000 for the first time on record. Now, to what's happening in the AI space. OpenAI buying the AI device startup co-founded by former Apple veteran Jony Ive, joining forces with the legendary designer to make a push into hardware. The $6.5 billion deal, the largest in OpenAI's history, will provide the company with a dedicated unit for developing AI-powered devices. For more, we're joined by Bloomberg's Annabelle Drulas, who, of course, keeps an eye very focused, firmly focused on what is happening in tech and innovations in this space. How much could this shake up the industry then, Annabelle?
Well, I think if the share price reaction of Apple is any sort of indication, it really could make some waves. We saw Apple actually dropping on this announcement, down more than 2% yesterday. This is a really important partnership, and it's something that the pair are actually saying was about 2 years in the making and grew out of their friendship. But the focus here, as you said, is going to be enabling or adding AI into a new hardware device. We don't know exactly what that is just yet, but they're saying that it could come out in 2026. So very significant, as you said, the size of the transaction. This is $6.5 billion. It's the biggest acquisition that OpenAI has made to date. So it's going to be $5 billion in equity, and the balance of that is going to be from partnerships. So essentially, OpenAI has invested directly into I/O in the fourth quarter of last year, so that makes up the other $1.5 billion. But $6.5 billion in total. The deal is expected to be closed in the summer. That's, of course, pending all the regulatory approvals.
And Jony Ive, of course, such a legendary figure within Apple with the Midas touch when it comes to these devices, so consequential in terms of the design of everything from the iPod to the iPad to the iPhone. Altman is saying, we're hearing now in terms of reporting, Altman is planning to ship devices from next year. That sounds pretty ambitious.
Yeah, and I think it's not just like the timeline for it, it's actually the quantity as well, because the Wall Street Journal did have some reporting on this, saying the plan is for around 100 million devices to be shipped out, debuting in 2026. Wall Street Journal is saying late 2026, but yes, as you said, it's a very ambitious target. Jony Ive is not someone who's, as you said, he's not unfamiliar with hardware devices either. He's very central to Apple and their moves in iPhones in particular, the look and the feel of those. He's someone as well that was very close to the former Apple CEO Steve Jobs, and someone who actually Steve Jobs once described as his spiritual partner. So it's a big shake-up of the industry. It's a very important partnership, but they did actually put out, OpenAI, some video of this and essentially going through the partnership in more detail. But essentially the pair are saying they've been friends for a period now, and it really is something that grew organically out of that partnership.
Bloomberg's Annabelle Drulas, thank you very much Indeed, on that partnership between Jony Ive and OpenAI. Watch that space then. 2026, hardware devices from, of course, the maker and designer of ChatGPT. Now, Qatar Airways says it could still buy wide-body jets from Airbus in the future, just days after announcing a record order for 210 long-haul jets from Boeing. Bloomberg spoke with the airline's CEO at the Qatar Economic Forum.
Our narrow-body will continue to be Airbus. We're receiving 50 321 NEOs starting next year. So our whole narrow-body fleet will be basically operated by Airbus. We continue to receive 350-1000, and there will always be a chance for another order from Airbus.
Yeah, Qatar's down one jet, isn't it, because it gave it to President Trump. Right, staying with airlines, EasyJet is set to report earnings this morning, with analysts focusing on summer demand ahead of the busy travel season. Charlie Wells is here with a preview. I spoke to the CEO of Ryanair earlier this week, and he said that demand for summer travel is there, and it's pretty broad-based. What are you expecting to hear from EasyJet?
Tom, so this is going to be a really interesting earnings day for EasyJet, because in some ways the market is telling one story about this company, but their report may tell a very different one. So if you look at the share prices amongst these budget carriers in Europe, you've got Ryanair this week, their share price hit a record. You've got Wizz Air performing relatively well, but EasyJet really struggling for takeoff this year, really basically flat, pardon the pun, on the year. And it's interesting because it's a really good time, kind of as your interview kind of went into earlier this week, it's a good time to be a budget carrier. In a lot of ways, the oil price has been a real tailwind here, right? They've been able to hedge. Ryanair was talking about how they were able to hedge that oil price on the back of that volatility at the same time as you have these more efficient aircraft coming online, right? And so in EasyJet's case, that's the A320neo from Airbus. So in a way, there's some constructive momentum for this company, but EasyJet's interesting because they are a budget carrier. They've got, but, relative to a lot of these companies, they have, they can charge more, but their margins aren't necessarily as good because they're flying out of maybe more expensive airports, more kind of prime airports, a little bit more difficult, a little bit more competition, say, with the legacy carriers, but they've been investing a lot. They've been investing in holidays, for instance, which are more profitable. So Ryanair set a really high bar, but EasyJet could surprise.
OK, let's see if they can meet the bar that was set by Ryanair, as you say. What is it likely to tell us broadly as we look at these airlines, the budget space, about the health of Europe's consumers right now?
Well, I mean, think about the data point we got yesterday on UK inflation, right? So that's not going anywhere. And I think these budget carriers are a really interesting tell because in some cases you can see evidence of consumers trading down from the legacy carriers towards these budget carriers, which is, pretty interesting. And that's helpful for these budget carriers to a point, right? To the point where the consumer stops spending on holiday travel. But it's looking like it's going to be pretty healthy so far. And interestingly, there's this idea that the Ryanairs, the EasyJets of Europe could benefit from a lower demand on travel to the United States, right? So the European consumer sticking to the continent this summer, that could be a real boost for them as well.
Yeah, something that Michael O'Leary of Ryanair also touched on. Where's your holiday destination of choice, Charlie?
I'm still deciding, but I love sun, I love the beach, and, I'm probably going to fly one of these three carriers, so maybe that's a consumer indicator.
Michael O'Leary is saying Spain is still top of the list in terms of UK demand, at least. Charlie Wells, thank you very much indeed, booking his holiday as we speak. Jamie Dimon, meanwhile, thank you, Charlie, says he cannot rule out the US economy falling into stagflation. The JP Morgan CEO gave an exclusive interview to Bloomberg's Haslinda Amin at the Global China Summit in Shanghai.
You talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So I saw last night's reaction. I don't worry about one day move in bond markets. So
you don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher, and some are talking about 10's getting to 5's, 30's getting to 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah, I don't know the answer to that. that we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary, and this is not all an American thing. And the infrastructure needs are inflationary. Now you have offsets. You have oil prices down there quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised.
As we said, it is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like?
Yeah, so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which you say it's not, but it is still higher than what it was before.
Would it go higher?
Will it go higher? And also, will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up. And they can't control. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be.
JP Morgan CEO Jamie Dimon, of course, speaking to us exclusively. Coming up, we're going to check in on the markets and speak to Beata Manthey, Head of European Equity Strategy at Citi. We'll talk about what's happening stateside with the bond market rout, what that means for the equity story in the US and the ripple across to the European space as European stocks continue to outpace their US counterparts year to date. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. European futures pointing lower, slightly lower, after yesterday's sell-off sparked by concerns about a ballooning deficit in the US. The sell-off was pronounced in the US. European markets, the Stoxx 600 actually ended up essentially flat after 4 straight days of gains. Beata Manthey, Head of European Equity Strategy, joins me now from Citigroup, of course. Beata, great to have you in the studio. As we focus in on what's happening with the US, the bond vigilantes appear to be rearing their heads. To what extent is the bond market sell-off in the US a risk for US equities? Before we get your view on what's happening in Europe.
Definitely, bond vigilantes are back. And of course, when it comes to the level of the bond yields, it's always about the reasons, right? If the bond yields were at these levels because we were expecting higher growth in the US, great for equities and the US equities as well, but global equities overall. But because they are up, because the market is worried about the debt sustainability reasons, it's not very helpful, especially given how strong of a rebound we've been seeing in equity markets around the world from the recent lows, right?
What is the level that you're watching for on the 10-year that would be the warning flag, the red light to you? Is it 5%, or is that when buyers come back in? Is there a particular number on the yield that you have your lens on?
So many people think that 5% is a magic number, right? Our economists don't think we are going to go to these levels, so we are still quite. I'm talking about treasuries, right? Yeah. But their concern is, and that's my concern as well, is that the higher bond yields eventually will mean lower GDP growth, right? Because the financing of the very high debt in the US is going to be even more expensive. This is going to eat into growth. And it's not an ideal situation with the pressures to growth that we've been already seeing through the tariff risks.
What does this do to the fund flows from US equities or US assets into European assets? Does it accelerate that story, or does it lead to broader contagion risks and money on the sidelines?
That's an interesting one. So we've been flagging the need of diversifying away from the US assets, diversifying, right? And given the scale of the US assets, just small diversification means a lot for the prices of other asset classes. And we started to see it in the fund flows, right? So the last few weeks, well, since the start of the year, we've finally started to see inflows into the European equities, and around 30 billion, right? Just below 30 billion. So that's a lot for European equities. However, in the grand scale of things, given how much outflows we've seen beforehand, and since the Ukrainian war has started, we've seen 16% of assets under management worth of outflows. So the latest inflows have offset only 10% of the previous outflows.
So
right?
There's another 90% to go, and the Stock 600 is up 9% year to date. The S&P is essentially flat over that time frame. That story, that divergence then continues through the year.
I think so. And it's not only the story of inflows into Europe that has been very under-owned. It's also the story of the US, which has been fully owned, especially for the international investors. So there are signs, and again, if it's going to happen, it's only starting, because it's just made a small dent in the previous inflows. So international European investors diversifying back to home.
What is the current tariff risk priced into European equities?
So how about I put it through the earnings risk? 10% tariff risk was, in our view, was going to take away around 3 percentage points of EPS. We've been seeing huge downgrades, not only in Europe. These have been indiscriminate, recessionary level of downgrades, so the direction of the analyst forecast, minus 60% a few weeks ago. That means for every 10 changes, you would have 8 downgrades and 2 upgrades. Huge amount of downgrades. That translated in Europe for growth expectations for EPS this year, from the start of the year, coming down from around 9% to 3% right now. So we've already shaved off 6% of that growth. Now, we have this model that tries to capture what kind of EPS outlook is priced in by the market. And it proves very helpful in times like this. So at the worst of the sell-off, it was telling us that European market priced in a flat EPS. Right now, it's pricing in around 4% EPS growth, which that's over the next 12 months, not for this year, which is still around 2 percentage points below the analyst. So the market, despite the rally, is still not as exuberant in terms of pricing in EPS growth. So I like to see buffer for some more downgrades to come through. When it comes to our targets, we still have around 5% upside by the end of the year. But we've been flagging that from these levels, probably it's going to be a volatile rise. And what is happening in the bond market right now adds to these worries.
So 5%, the volatility is there, the concern around the bond market. But there is some constructive kind of views in terms of how much is priced in on the tariff front for European equities with that focus on EPS.
If they are at 10%, right? If they are at 20%, we are too high.
Then we reassess. Before we let you go, you made some pretty bold calls on sectors the last time I spoke to you, with that focus on autos and an overweight. Was it an overweight view on autos? Talk to us about how you've revised any of those calls. What sectors are standing out to you right now?
Yes, so back 4 weeks ago, exactly when we've been seeing these recessionary level of earnings revisions, we've been flagging that historically that tends to be a contrarian buy indicator, especially for beaten up cyclicality. And at that point, we were in a balanced portfolio, a bit of cyclicality, a bit of defensiveness, portfolio for uncertainty. What we've done is we have not moved full into cyclicality, but we've dipped a toe into cyclicality. So our preferred growth cyclical, beaten up cyclical, continues to be tech, and auto continues to be beaten up value cyclical. Nonetheless, it's gone up 20% now, right? So you've got to imagine that from here we kind of need catalysts for that trade to keep on going. Okay. The signal is over the next 12 months. It worked very fast this time round, yes. Right? So let's see how that goes in the short term.
Okay, dipping your toe into cyclical, and we'll see what happens over the next 12 months, with some of that being priced into the auto sector already. Beata Manthey, always excellent insights on these markets, head of European equity strategy at Citigroup. Thank you. There's a lot more coming up. Stay with us. This is Bloomberg.
The Fed is basically an outlier. Every other central bank does this in one form or another that are peers of the Fed. And this would actually help the Fed to both communicate and also pivot when things turn out to be different than they expected. If you had a scenario in, say, 2021-22 that inflation might stay higher for longer, that probably made it easier for the Fed to terminate its large-scale asset purchase program earlier.
Former New York Fed President and Bloomberg opinion columnist Bill Dudley, of course, on changes he would like to see around the Fed and its communication style. Let's just remind you of what's happening in terms of the breakdown in the relationship between higher yields and the dollar, because you're getting a sell-off again. That was pronounced yesterday. Today, there's a bit of stabilisation in the Treasury markets, but yesterday that story was once again pronounced in terms of the sell-off in the Treasury markets, higher yield but weaker US dollar. You can see that gapping starting, of course, on quote-unquote Liberation Day, and that has continued with the moves focused again yesterday. Where are the buyers in terms of those treasuries? You had a pretty lackluster 20-year auction yesterday. The international buyers seemingly, at the moment at least, on the sidelines. The Sell America theme back again. To what extent are the bond markets going to be the guardrails around the legislation that could be making its way through the House just in the next hour? Also, we continue to watch that, of course, in terms of the tax and spend bill, that big, beautiful bill that President Trump has decided he's focused on, and lawmakers, of course, in Washington, D.C. Let's flip the board and have a look at the correlations then, or at least the linkages between that trade and what's happening in Bitcoin. Getting above $110,000 per coin for the first time ever. Part of that is some of that risk-off sentiment and the pressures on the dollar putting flows into crypto, it seems. But some of it is also the legislation and the regulation that seems to be working its way through on stable coins, which is seen as a positive catalyst for Bitcoin as well. So continue to watch that crypto, the largest, of course, by market cap. Bloomberg is going to be speaking to the CEO of EasyJet. The earnings drop in a couple of minutes' time. Stay tuned for that interview. The opening trade is up next. This is Bloomberg.